This is the Asia Climate Capital podcast hosted by me, Joseph Giacobelli. The series is dedicated to discussing and analyzing business and finance topics around the energy transition and decarbonization in Asia, with the capital markets in mind. Hello, and welcome to episode 13 of the Asia Climate Capital podcast, recorded on 29th of July, 2022. I'm your host, Joseph Giacobelli. Today we tackle a topic in climate finance, which in my opinion is not sufficiently discussed, carbon. It is a topic which is complex and in some marketplaces actually generates quite a bit of controversies. To unpack carbon from the sustainable finance and investment perspective in general, and in particular in the Asia-Pacific context, we have a really unique expert, Charles Bedford. Charles has been involved in conservation and climate for over a quarter of a century, and today has a leading role in carbon-related finance in both the investment as well as academic world, as he teaches at HKUSC or the Hong Kong University of Science and Technology. Charles and I are based in Hong Kong, but today we decided to do something a little bit different, and I will speak to him in the US from Europe. In terms of today's schedule, first we'll get Charles to give us a little bit of a rundown on how he actually got into carbon finance and the Asia decarbonization game in general. Then we'll dig into the current aspects related to carbon finance in Asia. And finally, I hope that can get Charles to share some of his thoughts on the development of carbon finance over the next 2 to 3 decades. As always, please note that all views and opinions are purely personal in nature and do not reflect those of any past and current employers. Hello, Charles, and welcome to the Asia Climate Capital podcast. How are you today?
Great. Thank you, Yosef. It's good to be on.
Well, thank you very much for making the time. I really appreciate that. If you don't mind, do you think that we could possibly start with just a short explanation on your path to today's involvement in Asia's decarbonization and the energy transition?
Sure, I can start as far back as you like, but how about this? I'm British born, but grew up in the U.S. And part of that was being in the American West and being outside and outdoors across the American West for most of my childhood, and really got to be an advocate even as a child for the environment. And that stuck with me through my career. I went to law school, became an environmental lawyer, worked in government, and became a manager for the Nature Conservancy, which is one of the world's largest conservation groups, and worked and ran chunks of that business in the U.S. and then in China, in Beijing, and then finally in Hong Kong, where I was managing the Asia Pacific region for the Nature Conservancy, about 400 staff and a 50 million annual budget. NGOs can only do so much, and because they're just working with charity, with charitable dollars and philanthropic dollars. They're great and necessary, but really, when you think about the global capital flows and the way that the economy works, those are forces or currents in the river that are really much, much more powerful than what philanthropy and charities can do. So a few years ago, while at the Nature Conservancy, we began to explore carbon finance as a way to protect biodiversity and to address climate issues. And I left the Nature Conservancy about 2.5 years ago to start a couple of efforts, really. One, a consultancy around conservation and the interconnection between conservation and finance. I jumped into the academic world with Hong Kong University of Science and Technology and taught conservation theory and practice, as well as a course on climate finance and the carbon markets. And then with a group of former Nature Conservancy staff and some former bankers, we started up an investment fund in the carbon markets. So we focus on the activities around the world that are gathering up carbon and sequestering it in the ground, or preventing or avoiding the emissions of carbon. There's lots of these activities. There's probably 6,000 carbon sequestration and avoidance projects going on in the world at the moment, creating carbon credits, which are then used by companies to offset and balance their carbon emissions. And this is really part of the energy transition, right? We have to do a lot fast and very well all at once. And one of those things is really figuring out how to avoid and sequester carbon. So that's my journey. It's been terrific, and love working with students at HKUST. I love working in the finance sector, bringing these kind of new ideas of bringing finance to the climate problem. And so it's been a fun ride. Thanks for asking.
Yeah, no, I mean, on the education side, I hope that the podcast will contribute to, knowledge sharing when it comes to climate finance in general, which I think there's still a long way to go in terms of fully understanding the complexities of the subject. Now, when I was preparing for our discussion, Charles, I really, to be honest, struggled to find a starting point, because I've always found that carbon financing and investing is a very complex area, because we're talking about complexities from the economic level, environmental, political, cultural considerations, etc. So I thought of adopting maybe being an investment banker or analyst, equity analyst, to adopting the Wall Street approach and follow the money. So on your company's website, there are some interesting statements which perhaps will get us started in this conversation. It talks about the investment returns on the assets under management. It talks about the financing of emissions reductions and removals. And finally, it talks about building a robust and efficient and effective carbon market. Could you please kind of start with explaining these three statements and unpacking and everything in 30 seconds? No, just kidding about the 30 seconds.
Well, the saying, if you can't make your point in 30 seconds, nobody's going to listen to it anyway. So, yeah. Well, look, let's start with the last one, and then you'll have to remind me about the first two, because I think the last one's really the critical one, which is a robust carbon market. And what does that really mean? And it's important to think a little bit about sort of what are we talking about here? So the world year in, year out right now is producing about 50 billion tons of carbon, ejecting this into the atmosphere and causing a greenhouse gas effect. The United Nations has recognized this problem since 1992 at the Rio Earth Summit, maybe even a little bit before that, maybe in the 88-89 timeframe. And over the course of the last 30 years, has put in place a set of essentially frameworks to try to deal with this massive emission of carbon dioxide and it causes the global warming and climate change effects. None of those frameworks are mandatory or enforceable in any way, because it's international law. International law doesn't, there's no international cop that goes around and says, hey, turn off the smokestacks, right? So this is all a voluntary system. Countries sign up to these agreements. The Paris Agreement, one of the most famous agreements from December of 2015, essentially said everybody needs to essentially set a budget for carbon and try to ratchet down that budget over time with a goal towards becoming carbon neutral. And that's not very easy to do. You can do it in two ways. One is through a regulatory approach, country by country, all 200 countries, sort of adopting ways, locally appropriate regulatory mechanisms to reduce carbon in the atmosphere and reduce their own emissions over time to get to zero, to get from 50 billion to zero. And I think that's important, and that's ongoing. And the other way you can do it is through market mechanisms. And the carbon market is really what was embraced in Paris, and then again at the Glasgow summit, UN summit last year, using market mechanisms. So either taxing carbon or creating a cap and trade system to manage carbon, or in the context of the voluntary carbon market, creating a system where corporates and countries who are becoming carbon neutral can go out and pay people to grab carbon out of the air or prevent carbon in compensation for their own emissions. So those are the options. The world, good news is the world is doing all of them now to some extent. I think it's something like 30 or 40% of total global emissions are now captured under some sort of tax, cap and trade, or voluntary reduction system. Companies have pledged to reduce their carbon by 2040 or 2050, 2030, depending on the company, to net zero. And they've pledged to do so by becoming more efficient and then offsetting their remaining emissions. Countries have all pledged and made targets that they say they will achieve. So all of this is on the right track, and that's what a carbon market really is. Sort of how do you use market mechanisms in the context of the broader climate change agenda to accelerate climate action. So that's the first piece of it. Is that useful?
Yeah, absolutely. So to talk about the current situation of the carbon markets globally and especially in Asia. So I think most of the listeners would be aware of the EU ETS, which has been around for a while. It's evolved quite a bit. It had a few potholes that it had to go over, but I think it's in reasonable shape, and it keeps on evolving. But where are we at? And we some should know that China has launched one as well. Hong Kong is looking at participating, et cetera, et cetera. So how do you see the actual carbon markets from a trading perspective right now? We'll talk about the kind of like the future in a bit, but how do you see the status now? I mean, are you bullish? Are you bearish? Are you more bullish in some markets, more bearish in others?
Yeah, that's a good question. Well, let's start first with just sort of the overview, and then I can give you the bullish and bearish analysis. So the compliance market, that is the market that is essentially cap and trade, which is the European Union's emissions trading scheme. That is a system there's taken off and really been perfected over the course of the last 20 years by the Europeans, and most of the rest of the world who are putting together emissions trading schemes like that, cap and trade schemes, are essentially following the European model. And the European model made some mistakes in the early days. They overissued allowances. They let too many offsets in from other places, but they fixed that. And it's a very stable system over the last 2 or 3 years. And we expect it to maintain its good work. And there's good evidence that emissions are declining in Europe because of this. The price of carbon is getting priced into carbon is getting priced into all of the goods and services in Europe. And the Europeans are even considering a carbon border adjustment mechanism to essentially make sure that goods coming into the European Union are also taxed at that sufficient level to embed the price of carbon into the goods. So you have systems, in particular in places like Australia, New Zealand, California, northeastern U.S., Quebec, parts of Canada, Colombia. Chile is considering a cap and trade system. The Singaporeans have just indicated strong support for a market-based cap and trade system. So there's a lot of activity on this front that is super positive, and that's the compliance market. And the Chinese, of course, have been experimenting with this for a number of years in various pilot provinces, and then last year around this time put in place the national carbon emissions trading scheme, and that's of course super important. Japan and Korea also are leaders in this. Korea in particular has been a leader in the carbon market. And so it's a really good case study to look at. So I'm optimistic on this movement towards cap and trade systems, and I think these are the compliance model is important to have. What these compliance models all have in common is they're trying to essentially capture the biggest industries, steel and power and transport, et cetera, in their system first, and then later they'll move into the smaller companies and try to decarbonize the other sectors of the economy. I think that's the right way to go, and I think it's exciting to see that happen. So I'm bullish on the compliance market. The voluntary market, I'm also bullish on. It's a market that is essentially driven by corporate ESG responsibilities. The boards of companies, the listing exchanges are all putting pressure on boards, investors putting pressure on companies to become carbon neutral. They're making very sticky and binding pledges to do so, and they're doing great work to decarbonize their own work, as well as to offset their carbon through the voluntary carbon market. So I think a lot of things are going great. That's my bullish aspects of it. I've got a couple of bearish points I'd make as well, which might, by contrast, I think the Americans have been, I think, spectacular failures on this front, with the exception of California, some of the other states and cities. The American politics just isn't going to allow a carbon tax or even a carbon emissions trading scheme to happen at the national level for the foreseeable future. American companies, on the other hand, are doing pretty well in terms of their pledges and their commitment to carbon action. So that's encouraging. But the American political system seems to be irretrievably broken on this front, which is a disappointment to me as an American. So that would be my one sort of bearish piece on that front. But otherwise, I believe that we're on the right track. We can't do it fast enough, but we are on the right track.
Talking about kind of some of the countries that you mentioned, but do you have any specific thoughts on Korea, on China, and perhaps on maybe what Australia may be able to do? Do you have any particular thoughts on any of these countries?
Yes, I mean, they're really different systems. The Chinese are going with a what's called an intensity-based emission trading system, and so rewarding firms for economic output, but done more efficiently in their carbon trading system. They also have a voluntary system which they haven't really stood up yet. And it's not quite clear that the system has got the right sideboards and rules in place yet to become a really good, robust system in China. Korea is interesting because it's been at this for quite some time. They have clear rules in place around emissions and trading with their compliance system. They allow for voluntary credits. So essentially the activities somewhere else that is essentially sequestering carbon, grabbing out of the air, tree planting, cook stoves, et cetera. They actually allow for that to satisfy part of the compliance obligation. So they're quite progressive. Australia has been back and forth on this, and their internal politics have disrupted some of the excellent work they did in the early days on creating a market. But it seems that they're getting back to it at this point with their new government, and the Australian, both the voluntary, essentially the carbon credit system, as well as the cap and trade system, is in good shape. So I think Asia is starting to look quite interesting from a carbon perspective, where just a few years ago, only I think Korea could have claimed to have made significant progress.
Right. I guess I'll get back to the markets in a minute, because obviously it's an important feature of the overall game plan, so to speak. The other 2 points that I wanted you to please unpack was the statements that the company website talks about the investment returns on the assets under management, and those investment returns seem to be very, very attractive. And secondly, also just a general financing of emission reductions and removals.
Sure. Yeah. So my fund, which I helped to start with some of my colleagues from the Nature Conservancy and a former banker from UBS, is an investment fund that's very focused on the voluntary carbon market. So essentially activities that are out there pulling carbon out of the air, putting it into the ground, substituting lower polluting technology for higher polluting stuff, renewable energy substitution for coal, efficient cook stoves being substituted for open fires in Africa. So that those projects actually are out there creating and generating carbon credits at a global level, and they are used by companies to offset their carbon. And we invest in those carbon credit producers themselves. So we invest in the credits they're producing or their forward offtake agreements, which we also invest in. We find the best credits, the highest integrity credits, the ones that we know are most likely to be reducing carbon emissions or grabbing carbon out of the atmosphere, and that also provide a suite of co-benefits for people in the areas that are producing these projects. So we invest in these projects. We hold those investments, and then we sell carbon credits to retire to companies over the course of time. The reason we've done this is because we felt like there was a lack of liquidity in the carbon market, in the voluntary carbon market, and we wanted to bring faster, more nimbler cash to project developers so that they could expand their work and to back that work that they're doing, especially those project developers that have great projects. We've been lucky, I guess, and maybe smart. Better to be lucky than smart, though. We've been lucky over the course of the last year and a half to see carbon prices rise significantly, and an increase in interest in the sector. And we think that's going to continue.
That's great. For some of the people like myself who are not 100% familiar about the whole processes, I mean, could you give us a theoretical, hypothetical case study on how you go about finding the project? How do you determine what kind of potential returns you can get out of them? And also, I think there's quite a bit of, let's call it headline news about some voluntary credits not being as kosher, to be diplomatic, as others. So could you a little bit unpack that?
Sure. Yeah. There's a lot to unpack. There's about 6,000 projects that are out there creating carbon credits for the voluntary market in the world. They've been registered in one of the, I think there's probably about 8 global registries now. Verra, VERRA, is one of the largest, or is the largest by far. It's probably a company encompassing probably 60 or 70% of the total issuance of those credits. And the market has issued over the course of the last 20 years, maybe 1.3 billion tons of carbon credits. So a carbon credit is equal to 1 ton of carbon that's been sequestered, avoided in emissions by this activity of one of these 6,000 projects. Now, there are probably hundreds of different ways to create a carbon project and to create a carbon credit. And they run from planting trees to substituting cook stoves to renewable energy, displacing coal in the grid in lower income countries. So there's so many different ways you can do this. Avoiding deforestation is one of the biggest ones, probably accounting for maybe 40% of the total credits that have ever been issued. Is avoiding deforestation. Now, what does that mean? It basically means, if you own a forest, if you're an indigenous population, then you can essentially agree to not log that forest and to keep it standing and to keep it absorbing carbon. And for that agreement, you are then compensated with carbon credits. And then you can sell those carbon credits to, let's say, Delta Airlines that is pledged to become carbon neutral. So that's the general gist of how this system works. Now, 6,000 credits, or 6,000 different projects, you've got to figure out which ones are the good ones and which ones are kind of the dodgy ones. But fortunately, most of these registries have pretty good safeguards in place. So the registries, the standards essentially are the keepers of the methodologies themselves, the recipe, if you will, for a carbon project type. And so they will essentially set the rules, like if you do X, if you do Y, if you do Z, then you will get a carbon credit. And then they have a third-party auditor that the project has to contract with to go out on the ground and check to see that the project has actually done what it says. So you have a little bit of a belt and suspender or a double check on the projects themselves in the registries. And I think all the registries are pretty similar. The standard bodies, which are essentially keeping the standards and certifying the projects. And then the underlying registries essentially track where those, how many credits have been issued and to whom, and then when they get retired, they retire those credits or cancel them. It's a pretty decent system. It's sprung up kind of out of, after the UN system, the CDM, the Clean Development Mechanism system, was put in place, and it has sort of phased out over the course of the last 5 or 6 years. So these groups are issuing credits. They're checking to make sure that the projects are doing what they say they're doing. They've got third-party audits. And then the market is looking at them with a lot of scrutiny as well. You mentioned newspaper articles about this project or that project not doing as well as it should be, or maybe overestimating the amount of carbon it's grabbing out of the air. So there's actually sort of a good feedback loop from the NGO community, the press, the media about the carbon credits themselves as well. So I think you have a fairly robust system for quality control. But our theory as a fund is there are good projects and there are okay projects and there are bad projects out there. And what we want to do for our investors is to get invested in those highest quality credits as quickly as we can, and then holding to those credits for a period of time until the corporate sector buys them from us for retirement. So that's our theory. Basically, we're just long carbon. Is what the simple idea is, and we're long the right kind of carbon.
How do you define a good project?
Yeah, we have a pretty extensive filter. We look for projects that, first off, have the right science, the right sort of simply basis for claiming that they're going to sequester a ton of carbon. And so what that means is, all of these carbon methodologies or recipes, when you're out there trying to implement them, you are doing a bunch of math and science. You're measuring trees. You're measuring sort of the output of a cook stove versus the output of a campfire in Africa. And then you're basically taking the delta, the difference between those two things, the action you're doing versus the action that's happening on the ground. And you're essentially saying, I'm saving this amount of carbon from being emitted. Now, that math is complicated and the science is complicated. And so what we look for are the best examples of that kind of science and math. And so we have technical staff that do the due diligence. We rely on third-party contractors and rating agencies who look closely at this math and the science of creating a carbon project. So that's our first screen. Like, is it actually real? Are they doing what they say they're doing? And does the math add up? Mm-hmm. So that's sort of criteria one, and that's the most critical one. The second one, which I think is also quite critical, is are the benefits, or sort of the suite of benefits that the community that the carbon credit project is happening in, are they benefiting, right? And If they're not benefiting, then those projects generally will fail because the neighborhoods, the communities are really critical to it. Let me give you an example. If you're trying to do forest conservation and you've got a bunch of communities around, poor communities that are around the piece of forest that basically that in many cases have some legal title or even informal land tenure on that property. If you're not compensating and working with those communities in a way to save that forest, then the forest will be unlikely to remain standing. And this is a lesson that my partners and I at the Nature Conservancy, when we worked at the Nature Conservancy, spent a lot of time around. Are the communities benefiting from this conservation work? Are they benefiting from this carbon sequestration work? If they're not, the project's going to fail. It's preordained. And so we do a lot of work to make sure that we understand the benefits are flowing to the community, financial, infrastructure, cultural, educational, hospitals, health. If those things aren't happening, then those projects are doomed to fail. So we look at the science of the carbon ton and whether or not it's done well and done correctly, and then we look at the benefits to the local community to make sure that we understand what they're getting.
I think that there's a couple of news that have hit the headlines regarding the carbon markets in Asia specifically over the past few months. One of them, which I found quite intriguing, is some issues, at least in Southeast Asia, with voluntary carbon credits. Not sure if you follow that, if you've got any opinions on that. And the other issue, which I'm not sure if the two are interrelated or not, is that post COP26 in Glasgow in November, countries have basically said, well, if you are a entity from abroad, say, for example, in Thailand or Indonesia, and you are generating carbon offsets in that particular country, you've got to keep them within Thailand. You can't use them or offset them in another country. I've explained that in an extremely terrible way, so I'm not sure if you could unpack that at all.
Well, it's okay that you've done a reasonable job, because the Glasgow summit, the COP, explained it in even less intelligible ways than you've just done. So we were optimistic that Glasgow would come out with some really clear guidelines, and we'd understand how carbon credits can get traded between countries, one country to another. Switzerland's never going to be able to offset it, or never going to be able to reduce it to net zero. So it's going to have to pay somebody else, some other country, like Ghana or Peru, which they have contracts with, to do carbon sequestration for them in order to become net zero. So we were hoping that so that's the one kind of transaction that Glasgow was trying to make clearer. The other type they were trying to make clear was essentially what happens when companies, like global companies like Microsoft or BP or Shell, what happens when they buy carbon credits in Indonesia or Papua New Guinea or Paraguay or whatnot? Do those credits count for the country's goal, or do they count just for the company's goal? And what COP26 did was sort of say, yes, we want markets to happen, but we're not going to really make any tough decisions about whether how this accounting is going to work. We're going to kick the can on that till next time. So they basically embraced the idea of global carbon markets, both voluntary and compliance, but they really failed to articulate clearly how the accounting is going to happen. So that's still a bit of a mess. And so what you'll see is countries such as Indonesia, which has recently, well, it's not recently now, but a number of months ago said, hey, no more selling of carbon credits out of Indonesia into the global marketplace, either to countries or companies, until we actually get our own act together with respect to how carbon is going to be treated in our own market, right? I mean, they're sort of saying, well, look, we've got to become carbon neutral, and we need to understand, and we need to be thoughtful about how we count the activities that happen here and how we finance those, whether the financing is coming from our own companies, from other countries, or from companies that are headquartered in some other country but have operations in Indonesia, or even those that don't. So they're saying, look, time out, and fair enough, right? I mean, when you have a UN body sort of issuing unclear guidance, you're going to have a lot of countries scratching their head and trying to figure out, well, how do we deal with this? We've signed up to do this Paris Accord and the Glasgow Agreement, and well, how are we going to get it done? So right now there's a fair bit of confusion around what's what in the carbon world, but ultimately it's moving ahead, right? In many countries, they're saying, yeah, we're fine with companies, global companies coming in and helping us to finance carbon sequestration, and we're happy to have the private sector and private landowners and indigenous people doing projects and getting that stuff done, and we're going to count those. We're going to count those projects as part of our nationally determined contribution for the UN purposes. So many countries are just getting on with it. Others are taking a time out to be more thoughtful about it, and then others are just disregarding it altogether. They haven't quite sorted it out yet.
Do you know much about what China is doing on this front, or what China's attitude has been on this front?
Yeah, the big breakthrough in Paris was that China came to the table for the first time and said, yeah, let's go. We've got to all set our national goals, and we agree we're going to sign on the dotted line. That was the big breakthrough in Paris. In Glasgow, similarly, they were leading, in terms of climate policy, global climate policy. But China encompasses 20% of the global population. So they're very climate threatened, right? I mean, climate change is a massive existential threat for 20% of the population in the world that they're managing. Some of the infrastructure issues, the coastlines of China, they know that climate change is going to hit them worse, and so they're very aggressive on trying to figure out how to move forward. But they're balancing it against economic needs. There's still 400 million peasant farmers in China that would like to move into the middle class. There's been 700 or 800 million people moved into the middle class over the last 30 years, which is the greatest economic miracle of in human history. But they still have a lot of economic tension, and so they're really trying to balance like how aggressive they can be with the need to continue to economically develop. And they've embraced the carbon market, and they've done a number of experiments in the carbon market over the last 10 years. And there's really no doubt, I think, that they're going to go down that track. China's not a command and control regulatory culture. So it doesn't really work to go out to factories and enforce pollution control laws, et cetera. There, it doesn't really work that well. So the market-based solution is, I think, one that they're embracing as a culturally relevant and appropriate tool to manage the carbon emissions. Now, it's complicated, right? It's the biggest country in the world. Not a lot of great record keeping around pollution, around CO2 emissions, et cetera. So they're moving forward with this national system. They're going to make mistakes, but they're also going to get it done ultimately. And I think the rest of the world is dependent on them doing it well.
Yeah, I mean, I would tend to totally agree with that. And I think one thing which is very often missing from the global discourse on what China is doing is really taking a photo of what's happening right now. For example, there's an economic crisis. They don't have enough electricity, so they set up their coal-fired power plants. Or look, China is polluting again. I think we need to look at the track record over the past 5-10 years, and also look at what they're going to be doing over the next 10 years, because the energy transition, et cetera, is not something which is going to happen. Sadly, it should, but it won't happen overnight. So it's kind of evolutionary. And that kind of brings me to the very recently, I think actually last week, the Economist magazine had this long report on ESG, and the general opinion was about, ESG is really not doing the job it's supposed to be doing. There's a lot of greenwashing, blah, blah, blah. My personal 2 pennies worth on that was that, again, it's evolutionary. If you look at the international financial standards, for example, that's taken, decades to work themselves through to where they are today. So when it comes to carbon, given its carbon finance and carbon financing, carbon investing, given its relatively new kid on the block when it comes to kind of sustainable finance, and probably one of the least understood, how do financial institutions today view carbon financing? I mean, do they really care about it? Do they follow it? Will they participate in investments or in the lending of a project which could which will generate carbon offsets? Is it positive view? I mean, how do you see the financial institutions, such as both commercial banks as well as some of the multilaterals like ADB or AIIB? It's a very long background for a long question. Sorry about that.
Right. Well, let's see. Let's start with the sort of the notion around lending and, well, can lending better change the world? I think this is the second part of the question, right?
Yeah.
And there's a lot of pressure on banks and multilateral banks to essentially not lend to dirty projects. Dirty projects meaning, those that are high carbon emissions projects. I think it's a reasonable theory that the more expensive financing is for coal plants and mines that are mining fossil fuels, the more expensive that financing is. It sort of helps to price in the price of those external costs of carbon emissions into the system. It seems to me like a pretty small tail to wag a big dog, I guess, is the way I put it. But it's also it's necessary but not sufficient. Let me put it more politely. I think if you're a global bank or a bank like World Bank or ADB or any of the others, you kind of have to toe that line, and you have to sort of push yourselves to be finding business opportunities to invest in as a lender that are not polluting, that are not, massive, carbon emissions mechanisms. That's just demanded by civil society. It's demanded by regulators. The SEC has just issued a set of climate disclosure rules around public companies. So I think all of those things are definitely, when you're forced to disclose what you're emitting and forced to disclose what you're going to offset and how you're going to tackle climate emissions by a regulator like the SEC, well, I think those are all exactly, as you say, an evolutionary step in the right direction. We'd like to get more tails to wag the dog and start having the dog be a carbon dog, I guess, to forgive my tortured metaphor, than just that. And that's why I think the carbon markets and the cap and trade systems, the compliance systems, and the voluntary markets really provide direct, specific action around reduction of carbon emissions and around sequestration of carbon. There you've got a clear, solid action that's being taken on the ground to advance the ball on the carbon front. Whereas, the ESG aspects are just a little too indirect to make a measurable, clear difference, especially because of the risk of substitution of finance from those who haven't pledged to become, those banks who haven't pledged to become carbon neutral or just to rein in their lending. There's plenty of other financing mechanisms out there. And so, you worry that you'll get a sector of the economy that is clean, and then a sector of the economy that's not clean, and the not clean stuff is still the same size. Well, that's not a good outcome.
If I were to ask you another tough question. In your kind of discourse with the banks, say, and I do appreciate it, 5 years ago, you hadn't set up the company yet, but 5 years ago compared to today, do you find that there's a better understanding, more interest, or it's just really developing at a snail's pace in terms of how banks look at carbon?
Oh, no, I think it's a huge change over the course of the last 5 years. Now, going back to my earlier point, whether they can actually make a big difference by changing their lending practices remains to be seen. But the awareness, the sensitivity is massively different than it was 5 years ago. There were a few leaders in the banking and the finance sector, 4 or 5 years ago. Now everybody is forced to talk about it, and you get a guy like I can't remember the fellow's name from HSBC, who was assigned to be their sustainability head, and essentially said, no, we shouldn't be paying attention to climate risk. It's too far off in the future. We only lend on a 5 or 6 year time frame, so why bother thinking about it? And he was immediately kind of flushed out of the system because it didn't reflect what the bank's official policy was. So look, what he was saying a few months ago was essentially official policy 5 years ago, and it's not that now. Official policy in the banks is very much more progressive. CEO, board, C-suite, and board level discussions around climate happen at every board meeting, at every sort of C-suite meeting. Both on the sort of regulatory side and the voluntary side. What are we going to do about the climate? And I think that's healthy. Again, a step in the right direction.
One last thought about this, and then perhaps then I will ask you to dig out of your desk your crystal ball and tell us what the world is going to be like in 20 years from now. The last question on this front is: do you have any thoughts on the fund flows? I mean, have you seen fund flows in carbon finance, carbon investing in the past, I don't know, couple of years? Have you seen a major increase, or has COVID slowed that down, or has Putin's invasion of Ukraine slowed that down?
Yeah, that's a good question. I mean, generally fund flows have been, ramping up dramatically since about 2019. So 2019 was kind of it was a bit of a delayed reaction to Paris, perhaps, like, oh yeah, the Paris Agreement. I guess that's going to start affecting us all, and we better get going on it. So you started to see some significant additional funding into the markets, and the EU system. The prices went from 20 euros to, now I think they're bobbling around 80 or 90 euros a ton. So you see a lot of change since 2019, 2020. The voluntary market has doubled in size every year for the last 3 years. Still tiny, still very small, $1 or $2 billion, but growing quickly. And a lot of interest from private equity, from institutions, family offices, et cetera, in the sector. And that I think is, what we have is a bit of a blip around Russia, which in some ways, clarifies some of the big issues around fossil fuels, right? I mean, the Germans are going to have to, wear a lot more sweaters and this winter. Because they had been over reliant on Russian gas, and to the exclusion of some obvious and better technologies and energy sources over the years. And so, and that's emphasized the need for decarbonization and to reduce dependency on carbon heavy fuels, fossil fuels. What we've seen since the Russian invasion of Ukraine is essentially, I think, in every sort of risk investment or higher risk investment, investors are just pulling back. We started a fund a year and a half ago, and we raised $100 million in fairly short order to make investments in the voluntary carbon market. We started a second fund in May this year.
Wow.
Started, right. Not the perfect timing, but look, we've already raised $30 million and we're on a track, I think, to get to a couple $100 million by the end of the year. So yeah, while it's risk off and while the people are very cautious, I think everybody realizes that this is a train that has a lot of momentum. It's headed down the track, and mechanisms like the compliance markets, the cap and trade system, and the voluntary carbon market are really the way that we can make things happen.
No, my personal 2 pennies worth. I totally agree with you. Actually, I've said it quite a few times on several episodes that the train has already left the station. So whether you like it or not, whether you believe in it or not, you better get on board. Otherwise, the train will go without you. So yeah, Charles, now you have to dust off your crystal ball and tell us what's going to happen in the world of carbon finance, carbon financing, carbon investing in the next 20 or 30 years. I know it's a tough question, but what are your thoughts?
Yes, I think the evolution of the carbon markets is on a track that's going to be very difficult to change. The UN has endorsed the notion of carbon markets, both compliance and voluntary, to try to tackle the emissions problem. The corporate sector has jumped on board. Civil society is pretty much checked the box as well. So I think we'll see is an evolution in the carbon markets to cover more and more sectors of the economy. You'll see also, I think, an evolution in the pricing of carbon. And that's really the key, right? Pricing carbon into all of our activities is the only thing that's going to get us to reduce our carbon emissions and to make that energy transition. So pricing carbon is everything, whether you're doing it through a compliance market, cap and trade system, a tax, or through the voluntary market. This is the critical factor. All of the big banks, Credit Suisse, Goldman Sachs, the consulting companies, EY, McKinsey, BCG, they're all projecting prices for carbon, global price for carbon that is going to be over $100 a ton within the next 5 to 6 years. That's a big difference from what we see now, where many jurisdictions are pricing carbon at 50 cents a ton or $1 a ton. The voluntary market, you can buy $1.50 a ton from an Indian wind project developer. But it's the same ton that a Polish power plant is having to pay $90 or 90 euros for. Doesn't make a lot of sense. And so we'll see, I think, in addition to prices rising and increasing coverage of the markets for carbon, we'll also see the increase in willingness to pay and increase in price and convergence in the market too. So you'll see leakage from the voluntary carbon market into the compliance carbon market. There's already interchangeability of carbon credits and carbon allowances in a number of systems, including Korea, Japan, Indonesia, Australia, Singapore, China, a number of others. So you'll see essentially this convergence of the carbon markets into a single, I think, global price for carbon, probably with some differences around the sort of quality and type of project, but we'll see more and more convergence. So I think you see more coverage, higher prices, better pricing into our activities, and I think that's a good thing. All of those things are on the right track.
Got it. Well, listen, Charles, I'm very, very, very grateful for your time. I really appreciate, this conversation, which I thought was extremely interesting. And yeah, thank you for participating in the Asia Climate Capital podcast.
Well, my pleasure. It was super fun to talk to you, and hope to do it again.
Given what's going on with the carbon markets, I'm pretty confident we will.
Awesome.
Thank you.
Thank you, Joseph.
Thank you for listening to the Asia Climate Capital podcast. If you want more information or you would like to send some comments or ideas for future topics, our contact is in the show notes. Thank you again.